This is the Rich Dad Stockcast with Andy Tanner, the show that kicks 401ks in the asphalt and teaches you to be the master of your own stock investing domain. And here's your host, Greg Arthur.
I wanted to start this podcast by telling you something that sucks. The process of our podcast does not allow it to be live. That kind of sucks. Well, this show's topic is something that is going on right now. The topic is consumer inflation and how to protect yourself as an investor. As I mentioned, this episode is not live. Today is June 10th, and it will probably get distributed in the next few days. But because this topic is so important and so timely, Andy is going to do a live seminar addressing this very topic on June 17th. I highly recommend you click on the link in the description and sign up. Andy Live is actually something really cool to see. He'll be showing you how to take advantage of one of the greatest credit expansions in history. He'll answer the question, with the Fed printing more money and pumping it into the stock than ever, are those activities making it the best time to get in the stock market? And Andy's going to do something he hates doing. He's going to give his predictions of the future and how he'll be using those to win. Now, we'll get into these topics slightly here in this podcast, but if you want the much, much more complete education, go to the description below and register to see Andy live. Don't miss it live because Andy will be answering questions live at the end, and you want to be able to get your questions answered. So let's bring in Andy. Andy, I've never, ever seen you this passionate before on a topic. In fact, you kind of scared me a little bit.
I'm a little bit lit up. My general personality is one of friendliness and optimism, and you know me. I like to have fun, and I don't want to scare my kids. I've just been looking at charts. Robert has been preparing for this for many, many years. Since 1971, and there's two frustrations I have, quite frankly. I'm just going to speak very candidly and very frank. It's all we want to have a fun podcast and we want to have people feel good, but I'm going to be just very, very frank. Two things that I struggle with. Number one is I don't know how to summon the language to get people's attention on this because of all the noise that's out there, right? Everything's an alert, everything's an emergency. So when there's a real one, there's so much wolf crying going on that when there's something that's freaking serious, how do you get anyone's cockeyed attention? So with that one, I just shrug my shoulders and say, well, all I can do is my best. If people don't want to listen, that's going to be their issue, right?
Okay, you're saying this is super serious. We just got through.
Dude, let me tell you something. A year ago, March, I'm on a webinar and there's thousands of people on this from all over the world. And there's a dude in Italy, and they were in lockdown because COVID had hit Europe, hadn't hit the US as hard yet. And they're panicked and they're texting me through the system saying, dude, we're in lockdown, but we're glad you're here. Tell us what to do. We're panicking. And people have already freaking forgotten how scared they were about their money, their families, their lives when the pandemic, because now, got vaccine, numbers are better. Oh, everything seems fine. Let me tell you what, man, stock market's up. Tell you what, I am more concerned today, and I was scared that back then, but I was more concerned today, like June 10th, than I was back then because of what I'm seeing in the charts and what I'm seeing in the sovereign fundamentals and the way this is starting to the gravity of fundamentals is starting to take hold. The consequence of credit expansion we're seeing and the fallout from coronavirus isn't going to be the coronavirus. It's going to be the money that we printed. And I don't know how to get people's freaking attention. So since I don't know how to do that, I'm just going to speak as loud as I can, as strong as I can, do my best. I always tell my kids, when you don't know what to do, just do your best. And if people don't want to listen, that's going to be their issue. So that's the first thing that's frustrating. The second thing is, my sister's a concert pianist. She's played the piano her whole life, practiced brutally, hours and hours a day, extremely accomplished. And what if I went to her today, who, I played very little piano. I quit my piano lessons early. I couldn't stick with it. And I went to my sister and I said, hey, I got a freaking concert. I got to play some Frédéric Chopin in front of 1 million people here next week. Could you give me some advice on what notes to hit? Could you give me some freaking advice on how the dynamics work and the key changes work? Could you just, I got this thing coming on down the pipe next week. I'm not really ready. So could you just kind of give me a few tips on how to freaking play the piano. And that's the culture of advice that just destroys people, because now I guarantee you, I'm going to have another webinar with thousands of people on it, not knowing what to do, and they haven't been prepared. So my frustration is what we're going to talk about today. It's going to go over a lot of people's heads. And our job is simplicity. Now, if I'd have started playing the piano back when it was do, re, mi, maybe I can understand the do, re, mi stuff. But I can't play Polonaise Chopin in a freaking half hour of piano lessons. So I know I'm kind of lit up, but it's fear. I mean, I see what's going out there, and I'm concerned more about this and the wave that could come. And I'm investing in some investments right now. I hope I lose every dime on. I hope I lose every dime. I bought some stuff today, and I brought my son in. I said, son, I hope we lose every single dime we put into these investments today and yesterday. I hope we lose every single dime, because they're insurance. In the same way, I'm buying insurance for my car, saying, I hope we never use it. I hope I lose the money. I hope we never crash. I'm buying inflation, what I think will be inflation insurance, and I hope I lose every dime. I hope I lose every dime and say, oh, we lost that money, because I can handle those losses. But hyperinflations, big inflations, even if it's not hyperinflation, plywood's gone from $18 a sheet to $80. That's not doubled, tripled, that's a quadrupled. Okay, that's 400% increase. You're seeing gas double. You're seeing everyone's raising their prices across the board now. It's going to hit the grocery stores, and this is how it starts. And people have already been trained to panic, because what happened to grocery stores in coronavirus? They've already been trained that they understand, okay, it's every man for himself. It's getting the toilet paper, it's getting the stuff. So they're already queued up to go crazy on this stuff. So my counsel is learn as fast as you can. So with that long craziness, that I'm usually not this crazy, it's just frustration. You can feel it. Trying to get people's attention and trying to say, look, you don't have time. You got to start right now and learn as fast as you can. I don't even know. I've traded crashes before. So coronavirus, I was very confident in what I was going to do. I was going to, sell some puts to buy some stuff cheap. I was going to pick stuff up on the cheap, very believing that coronavirus would come and go and the market would be back. I've been in crashes before. I've never traded a hyperinflation. This is going to be my first time. And it would be, if it happens, I've never traded a massive inflation, let alone a hyperinflation. And I don't know that we're going to have hyper right now, but I'm seeing enough inflation, enough places that learning how to trade inflation and learning how to deal with that is something I've studied for a long, long time. And it's going to be interesting to see if I'm right, to see if what I do. I hope I lose every dime. I hope it's insurance. I hope we have no inflation. I hope I hope plywood goes back down to $18 a sheet. I hope gas gets back down. I hope food gets back down. We'll all be better around the world. But Greg, I'm telling you, you've seen hyperinflations in Zimbabwe. You see them in the Weimar. You see them in countries sporadically throughout history. This could be the first global where everywhere it could go. Just like how coronavirus spread throughout the world, this could spread throughout the world. So I'm just telling you, Robert, his default setting, he's been screaming this for years. So people don't listen to me or listen to him, but maybe they'll listen to me if I join my voice to his, and just say, look, guys, wake up and learn it. And okay, so let's say you learn how to deal with it and it doesn't happen. What a blessing. What a blessing. I'm not predicting, I'm preparing. So kind of lit up, kind of small. I'm getting ready for this webinar where we're going to talk about what to do, and we can give a little preview of that. But just please understand, I can't teach you Chopin when you're at a do, re, mi level. It's time to up your game and go from math to algebra to calculus as fast as you can.
Hey, Andy, like you said, Robert's been preaching this for a long time.
Yeah.
But what happened that made you suddenly get on this bandwagon?
Well, I've never not been on the bandwagon. Okay. I've said, yeah, it's going to happen. It's going to happen. It's going to happen. Okay. Now I see it. I see the charts moving. I've read charts for a long time. I see the charts moving like, okay, this is what it looks like when it does happen in the beginning. This is what it looks like when it happens. Now, whether it'll continue, I don't know. But I do know it's not like we're all fine. I know that what's happening right now is what it looks like. And when when you see this in the context of having printed $5 trillion in the last 14 months, 15 months, and now it gets a little bit, gets my attention. It's got my attention.
All right, so let's dive into it. And I know we can't do it like I said, is
do my best to make it simple. I pride myself on making it simple, right? Our goal every day is in this podcast is not to say stuff people don't understand, use jargon to understand. Look, there's no time. It's time to play Chopin. There's no more freaking do re mi. We got to up the level. So I'll do my best to make it simple. But let's talk about what inflation is. Look, there's a battle right now. Okay, it's very simple. Right now, my hands aren't moving, okay? So everything looks calm, but the reality is I'm pushing as hard as I can on both sides. So it's not as calm as it looks. Even though it's not moving, it's not calm. I mean, my muscles are freaking flexed to the max. I got white knuckles. So even though something isn't moving, doesn't mean there aren't forces at play. So think of a balloon. A balloon looks stable. That's consumer price index. It looks stable. But if we turn the balloon around, there's a hole with air coming out and a pump with air going in, trying to keep it stable. Well, the one force is inflation and the other force is deflation. What makes things go down in price? Okay. Unemployment makes things go down in price. When people don't have any money, they can't spend it, so people drop their prices. High interest rates are deflationary. If people can't afford to borrow money, then they can't go buy stuff. So if you can't work, you got no money to buy stuff, and you can't borrow, you got no money to buy stuff. No work, high interest rates, lower prices. Make sense? Coronavirus caused unemployment. It stopped money moving. No money moving, no theaters being seen, no basketball teams. Now you got stuff full, right? Now you got stuff full. So deflationary stuff. Another thing that is deflationary, technology. I get an Apple cell phone and the next one has a longer battery, it does more stuff, and it's usually cheaper, right? So technology is deflationary, high interest rates are deflationary, and unemployment's deflationary. So you got those forces huge in coronavirus, okay? So what do? They drop interest rates to take care of the not borrowing problem, and they print a bunch of money and give stimulus checks to take care of the unemployment problem. That's inflationary. So there are forces going at it, man. There's inflationary. Well, if you push one too hard, it can get away from you and this bone can snap. And if this bone snaps, the inflation wins. And if this bone snaps, the deflation wins. So one looks like Venezuela and the other looks like the Great Depression in the United States. The Great Depression in the 30s, 1929 crash was deflation, high unemployment. There you have it. So let's start with that. High interest rates, high unemployment, technology, deflationary pressure. Globalization, deflationary, right? Because labor overseas is cheap.
Right.
Okay, drops prices. Low interest rates, subsidies, printing money, that is hot. That is inflationary pressure, right? Is that pretty okay to understand there?
Yeah, that's very clear.
Okay, now, if you have deflation, what do you want your asset column to have? Cash. In deflation, the problem with the Great Depression is no one had any freaking money. Unemployment, soup lines. Why is there a soup line? No one has any money. They got to stand on the soup line. So having cash in deflation is freaking awesome. It is awesome to have cash in deflation because prices go down and you have more than enough money to buy things on the cheap. Does that make sense?
Yes.
So you want to have cash, not stuff, in deflation. If you have an apple, you have stuff, not cash. In deflation, your apple loses value and you can't sell it. If you got a bushel of apples, let's say you paid $70 for the bushel of apples, and now apples are $35 a bushel. Your apples, it isn't what you wanted. You wanted cash so you can buy twice the apples. So in deflation, you want cash, not stuff. In inflation, you want stuff, not cash. In other words, if I have a bushel of apples that I paid $70 for and I have the apples, and now apples double in price, I'm really glad I have the apples. But if I have $70 and no apples and the apples double to 140, I wish I had the apples because my cash isn't worth as much. Does that make sense?
Yes. But so Robert Kiyosaki answers that question, what to do with inflation. And he says, Get in as much debt as you can and use that debt to buy as many assets as you can.
Well, here's the key. What do you want your debt to be about, and what do you want your leverage to be about? Because it doesn't need to be debt. There's other forms of leverage. Debt's a great one, might be the best one to have. I mean, if having stuff is the worst thing to have in a deflation, right, and cash is the best, what's the opposite? Having debt would be awesome in inflation, right?
Right.
And that's a conversation I'll let Kenny and Robert have. But basically, in real estate, if you inflate, you have a fixed payment on your debt, but your rents are going through the roof.
Right.
You had a fixed payment on what you paid for the house, but the value of the house is going through the roof because the dollars aren't worth anything. It takes $1 million more to buy the house. So debt is awesome in inflation. It's fantastic in inflation, especially if the debt can be sustained by a cash flow at a fixed rate. Okay, so that's debt. But there's other leverage you can use. I've got some debt I'm using, but I'm in real estate, but in the stock market, I use options for my leverage, and that is no debt. There's no debt there, but there's massive leverage. And I'll just, in all disclosure and disclaimer, I bought some options. I bought a bunch of options lately, long-term. Some of them are 2 years out. They're called LEAPs, long-term equity anticipation securities. I hope I lose every dime.
Right.
You know, I'll do what's called a leap with a covered right to subsidize those in time. I know that's language people don't understand, but hey, I can't do I can't. What are you doing? Do re mi? No, I'm not. I'm doing more advanced stuff than we usually talk about. And
Okay,
so
hold on. When we're on the webinar, will that all make sense?
Yeah, well, I'm going to do my best. Like I say, I'm going to try to catch people up, but let me see if I can make it make sense here.
Yeah.
Okay. One thing that is consistent in deflation and inflation is you want to eat. I talk about 4 necessities of life: food, clothing, shelter. You know what the 4th one is? Most people think food, clothing, shelter. To me, medicine's pretty important. So here's the thing: shelter, you know, you got your house, you'll probably be okay. Government probably won't evict you. Shelter, okay, great. If you're Kenny, you know, the government will subsidize the rent, hopefully. And, you know, he might hurt you with, you can't evict anybody, but most consumers, are they going to be homeless? I don't know. I have no idea. Clothing. Well, Marcy says I wear stuff that's way too old anyway, so I don't worry about clothing. I'm not growing anymore. Food and medicine, those are not fixed. They don't just sit there every day. They're consumables. Do you follow?
Yeah.
So the thing that a hyperinflation and deflation have in common is hunger. In a deflation, you can't get any food because you don't have any money to buy it. There's food, but there's no money to buy it. And so that sucks. Imagine having food there, but you had no money to buy it. So crime goes up, right? In a hyperinflation, the shelves go bare because people try to buy it so quickly, because buying it today is cheap and buying it tomorrow, who knows? So I'm going to hoard food and I'm going to clean out the shelves now. So either way, the shelves are bare. In deflation and hyperinflation, there's none to eat, right?
Right.
And so food to me is a big deal. So one of the things that I think about is, okay, there are commodities futures where I can get a claim on food. So if you have a hyperinflation, you want stuff, not cash. You follow? You want stuff, not cash. Well, how would you like to have 1,000 bushels of apples if the price of apples is tripling every 3 months?
Right.
You want to have the cash or do you want to have the apples? Which one?
I want the apples.
So where are you going to, do you have any apples at your house? Do you have a place to put apples? Do you know where to go? So what we do is we use options and futures to have the right to buy apples cheap in the future. In other words, I'm using ETFs, futures, options on futures to secure prices on stuff that are low. So when they inflate, the value of those contracts grow exponentially. Now, those are let me say this as loud as I can say it. Insurance is like the riskiest. What I'm doing right now is the riskiest thing you can do. Think about it. How much money have you made on your car insurance if it doesn't wreck? It's a loser. Every month, it's a loser. You follow? Yeah. If the insurance is only good if the car wrecks, if the house burns, if the body dies, the life insurance is valuable. As long as I'm alive, my life insurance, my term insurance isn't valuable. Term means time. So options and futures are term. They have time to them. And so if I go out and I buy a ton of leaps on commodities like gold, gas, oil, food, orange juice, staples, stuff, and the stuff doesn't go up in value, I'm going to lose that money. But here's the cool thing. Instead of actually spending all the money on the stuff, which would be expensive, I'm spending small amounts of money for the right to buy this stuff, which right now is relatively inexpensive. So here's the good news. Now, see if you can catch this analogy.
Okay.
Let's say our bushel of apples is $70. And if I buy the apples at 70 now, I have the stuff, I paid 70. If they double in price, I paid $70. Now I got $140 worth of apples. That's awesome, right?
Yeah.
I doubled my money essentially, right? And now I can sell apples to other people for medicine, right? Because medicine, you got to get a prescription. How do you hoard medicine? You got a prescription every month, right? How do you hoard medicine? Well, you can always trade food for medicine. Now watch this. But let's say instead of spending the $70 on the apples, let's say I spent $7 to lock in a $70 price on apples a year from now. Now I'm only spending what? $7. Okay, now if over the next year, the apples are now $140, I now turn that $7 into $70 of equity in there. It's exponentially growing. That's so if I want to keep pace with the inflation, buy the apples and just let them grow with inflation. You're paced, you got your food. But if you want to benefit from the inflation and take a risk, here's your upside. Your upside is you spend a small amount of premium. Now you got the leverage, same as debt, with no debt. And if it hyperinflates or goes big or even doubles, you grew tenfold instead of double. You stay ahead of the inflation. That's my theory. I've never done it. I'm doing something here that I prepared to do, but I'm going to confess, I'm a student when it comes to investing in hyperinflation. So I've never done it, but I think I understand the principles pretty well. And my hope is that I would spend the $7 on the apples and the apples stay at $70 a bushel. And I lose my $7. That's what I'm hoping for. Now I spent a lot more than $7 on long-term equity anticipation securities on staples, commodities, food, stuff like that. And it's a large sum. I think the average person would say, Andy, spent a large sum. And I talked to my son today. I says, I hope we lose all this money. I hope we lose it the same way if you were to add up all the premiums on your home insurance, all the premiums on your life insurance, all the premiums on your car insurance. You said, gee, over the last 3 years, I hope I lose all this money. Well, that's the way I look at this. I hope I lose every freaking dime I put in here. I'm looking at the total right now. I hope all that money's gone, because if all that money's gone, that means that everything was fine and I lost some insurance money. I can handle the amount of money. I would love to lose this money because I've got other assets to pay for it. And if the status quo happens, I'm okay with losing that money. I'm all right with it. I also have got physical gold. I hate Bitcoin. Robert loves it. I'm buying it not because I like it. I'm buying it because I feel I have to. It's a thing. It's been down huge. You know, I've lost a little bit of money in Bitcoin, but my gold has done way well. So that's what I'm doing is I want to have stuff, gold, Bitcoin, food. Well, I can't fill my house with food, but I can fill some of it. I have some food storage, but you can only hoard so much food in your house. So I have options on or futures, and you can even do options on futures to get leverage on top of leverage. But here's the nice thing with options. Options have fixed risk. In other words, when you buy insurance, you pay $100 for an insurance policy. That $100 is the most you can lose. But if you crash your car, it's now worth $50,000 in a new car. The $100 that month turned into 50 grand if it crashes. If it doesn't crash, you lose the 100. So unlike debt, where you owe something, I'm just paying a small premium. I hope I lose it all. But if I just look at plywood and I'm like, okay, if plywood can go from 18 to 80, you know, and gas can go from 250 to 5, then, you know, these commodities can double, food can double, apples, orange juice can double, beef can double. And I've not found any person lowering their prices. I'm raising mine. I'm going to raise my prices for sure, because what I have is becoming more valuable. So I see my prices going up next year for my financial education for sure. There's no question. because the money's worth less. Why would I want money? Why would I want to give stuff away for money, right? If it's becoming less valuable. So it's a huge, huge thing to understand. I don't know how much of this made sense to people. Just catch this. Deflation, you want cash, not stuff. Inflation, you want stuff, you don't want cash, because the cash just loses its value and the stuff goes through the roof in value. The scariest feeling in the world as a father is to have a hungry kid and say, son, here's some food, but I have no money to buy it. Or to have a hungry kid and say, well, I got lots of money, but there's no food to buy because it's been hoarded, because it's just off the shelf so fast. And thinking, will I have enough money to buy it at astronomical prices? You know, look, low prices do good if you have no money, and high prices do no good if you have little money and your money isn't valuable enough to keep up with the inflation. So I went to dinner with my friend Jose Enrique, who just fled Venezuela 5 years ago. He fled, and Chavez was taking power, and he went to vacation in Cuba, and the Cubans like, why are you voting for this Chavez, guy? It will free gas, free education, free, we've got all this oil in Venezuela. We're going to make everything free, and everyone should have the same stuff. We should all be equal, and we shouldn't be working so hard, because since we have riches as a country, why shouldn't we take our country's wealth, disperse amongst all you guys, and we'll all be rich? Guess what? There's not enough riches in the country to give everyone free education, to give everyone all this stuff, unless you decide to print the money, which is the MMT theory, that printing money doesn't matter. And the Cubans told this guy, goes, why are you doing this? Castro did this and killed us. Aren't you smart? So he goes to Venezuela. Sure enough, this stuff happens. He flees to the United States. Now he's watching the MMT guys on TV and all this free stuff and, giving out subsidies, printing all this money. He's like, where can I flee now? Because Europe's doing the same thing. Japan's doing the same thing. He goes, where do I go now? I've seen this movie before. Where do I go? And I asked him a question that scared me. I says, Enrique, what does it look like when your boots are on the ground? What does it look like in Venezuela? I mean, obviously people have to figure it out, right? And the table, we were at Maggiano's having spaghetti, and the table got quiet. And he was there, his wife was there, Noah Davidson was there, and my wife and kids were there. And the table got quiet. And Enrique's wife says, Andy, they starve. I go, yeah, they're hungry, right? She goes, no, Andy, they get sick and they pass away for lack of food. I'm like a few people? She goes, no, like a lot of people. I go, so they don't solve this problem? She goes, no, they don't. That's why it's a human tragedy. And the government, and I go, so how do they eat? And he goes, well, the government takes control of it, and the government subsidizes it, and you eat what they want. And the food loses quality and it's not as good. And you know how the government does things. Now, this is a horrible scenario. And I'm not making a prediction. I'm making a preparation. You understand? Look, yeah. I don't know that look, the most horrific news I could get was what my friend got. My best friend calls me, and his brother, Mark, he says, Mark's just been killed in an auto accident. It's the worst possible thing you can have is death. It's horrible. It's horrific. He had insurance, right? His wife, and he had two twins, 8 weeks old when he died, but he had good life insurance. And thank heaven for that. So I'm not saying that everyone's going to die of starvation. I don't know. I just know that it's happened in other countries. I just know that we've printed $5 trillion in the last about 18 months. And I just know every commodities chart that I'm looking at is starting to go like this. And I'm like, okay, I don't want cash. I want stuff right now. I don't want cash. I want stuff. So I'm taking some of my cash and I'm putting it in the right to buy stuff cheap now in the future, which is called an option or future. And they both have terms and expirations. And what I hope is that 2 years from now, when these options expire, that I lose all the money, that I lost it. And I say, geez, isn't that awesome? Because if I lose all that money, that means I probably made a bunch more in my other investments here, and people are still paying rents, and I'm still collecting dividends from Coca-Cola and Kraft Heinz and all the stuff I own. And that's my thought. So could I be wrong? Absolutely. Is a more sophisticated guy than me going to say Andy's moronic? Maybe so. All I know is I've studied as hard as I can as a student. I continue to study, and I'm not making a prediction. I'm just saying I see the chart starting to go like this right now. I would just tell people, why not be prepared? Why not learn these principles and be prepared. And if it doesn't happen, fine, you lost some money in insurance, great. But then you have more knowledge and you understand inflation better and deflation better. But this I will say, don't let the consumer price index fool you that it's just sitting there relaxed like this. Okay, it's like this. It's not moving. If it's relaxed, it's not moving. It's intense, it's not moving. But the forces of deflation, the reason we're pumping $5 trillion into the economy to keep it inflated is because there's an equal amount of deflationary pressure that wants to kill it. Why do you think they spent the money? It's medicine. So how much medicine did we need? We needed $5 trillion worth of medicine not to die because we had a $5 trillion deflationary sickness. If we had not spent that money, we'd have gone into depression for sure. We'd be in depression and we'd have 1929 all over again. But they made a decision with Alan Greenspan in 2000, and then with Ben Bernanke, and then Janet Yellen, and then Jerome Powell. They have made a decision throughout their tenures that we will not go to deflation again. We will kill the dollar before we do it. And what bullets do they have? What could happen? They could raise interest rates and stop printing money. Well, if we take the muscle out of the inflation side, then the deflation side will win and we deflate. So what does the Fed do? And so they're claiming they can keep this dance balanced and they can handle it. And let me tell you what, you raise interest rates 1 point, market's crashing, right? You raise it, you drop interest rates 1 more point, market's soaring. So every little tweak they do causes this huge thing in the markets, huge things in prices, and they're having to tweak bigger and bigger, which is making bigger swings and more volatility. And I would never want to work for the Fed. I'm not smart enough to do it. I don't know how to tweak interest rates and printing money against inflation and deflation. And so I don't know if they're nervous. I don't know if we had Jerome Powell in here, if he would be as nervous about it as I am, but I'm trying to prepare. And I'm kind of an emotional guy. I'm easily scared. I'm easily excited. So maybe I'm overly reacting, but my mind, when I calm it down, I say, okay, if we have significant inflation, would I be happy that I bought this insurance? And I see this parabolic upward, profit, even in a doubling of prices, right? I see a huge increase in profits. Okay, on the downside, I see a fixed premium that I could lose fixed. So again, that Apple analogy, I spend $7 to lock in my price at $70 a bushel for apples, let's say. I don't even know what apples are, but it's apples to apples. But if they inflate, I can still buy low at an affordable price and sell them high and stay ahead of it, hopefully, at least keep pace somewhat and be hurt less. I hope I lose every dime I put in these premium. I hope it's just like my insurance or my car, house, life, whatever. But I will tell you this about your 401ks and everything else. You've insured your car and your house today. Okay, great. You got your fire insurance on your house. What do you think is more likely to burn down in the next 24 months? Your house or the US dollar? Your house or your 401k? If deflation wins, your 401k is toast. If inflation wins, your cash is toast. And I don't know that it's going to happen, Greg. I don't want to be Chicken Little and say, oh, I'm predicting this will happen. I'm just saying there's 5 trillion reasons to pay attention to it. And they were all printed last year. That's all I'm saying.
Okay, Andy, I'm gonna cut you off here before you have a stroke.
Well, I'm not having a stroke. I'm more worried about everyone else. I really am. I don't know. Maybe I should worry about myself too. But I look at where I have insurance wise. If we go up, I think, okay, I'm good. I'm good with that. I'm good with that amount.
All right. I'm also gonna come over and give you a couple shots of bourbon. But I do want to tell people.
Drink with Greg, huh?
Yeah. I do want to tell people that I'm gonna use this word, that there is hope, because there are strategies you can use.
Yes, there are.
Watch Andy's webinar, his live webinar, or even if you watch the what's the word, the retake or the rerun, watch this webinar, learn really what Andy's doing so that you can get the education, mimic it.
You can decide for yourself what you want to do.
So I do want to say there's hope. Andy, you are the world's hope right now. No. There's a little pressure for you.
I think that's going a little far, Greg, but I'll do my best. I'll do my best to share what I've learned so far and what I'm thinking about. Look, I need to, you know how I feel about being straight up. Okay. And so it's important for me to say, when it came to the coronavirus crash, I was pretty confident because 2000, 2008, we've been there before. We know what happens and we have history. I didn't live in Russia. I didn't live in Peru. I didn't live in Argentina. I didn't live in the Weimar Republic. I didn't live in Venezuela. I didn't live in these places. So I really am dealing with something and trying to prepare for something I've not done before. I can be totally wrong, but I'd rather have some plan than none. I'd rather have some insurance than none. Right, so we'll see if I'm wrong. We'll see if I'm right. We'll see if I'm dumb. But I'm glad I know what I know.
All right. Well, Andy, thank you. Everyone listening, check the show notes. Register for Andy's webinar, free training. And we're going to call this show over, Andy, because I'm going to go drink. So
I'm gonna go drink some water.
No. Everyone invest in Jack Daniels right now. I'm sure that's the right answer. I'm positive.
Hyperinflation on Jack Daniels.
Yeah,
Take care, Greg.
All right, man.
All right, we'll see you, buddy. Awesome.
Bye.